Before we begin, this video is for educational purposes only and is not financial advice. Always do your own research before making any investment decisions. If I woke up tomorrow with zero investments, zero savings, and had to start completely from scratch, what would I actually do? Not the complicated answer, not the answer designed to sound impressive. The real, honest, step-by-step answer that I would genuinely follow myself. In this video, I'm going to walk you through exactly how I would invest starting from zero today, every single step in order. If you're just starting out, this might be the most useful video on this channel. Let's get into it. Before touching a single investing app, before buying a single ETF, before doing anything, I would fix my financial foundation first. Because investing on a broken foundation is like building a house on sand. Here's what fixing the foundation means. First, I would look at any high-interest debt. Credit cards, personal loans, buy now, pay later balances. Any debt charging more than 5 or 6% interest needs to be eliminated before investing a single euro. Why? Because paying off a debt charging 15% interest is a guaranteed 15% return, better than almost any investment you can make. There is no ETF that reliably returns 15% per year. Paying off high-interest debt first is always the mathematically correct move. Second, I would make sure my income covers my essential expenses with something left over. This sounds obvious, but many people try to invest while actually spending more than they earn. You cannot out-invest a negative monthly cash flow. Sort your budget first. Once high-interest debt is cleared and cash flow is positive, then and only then would I move to the next step. Before investing a single euro in the market, my next priority would be building a small emergency fund. Not the full 3 to 6 months right away, just a starter emergency fund of around 1,000 euros. Why start small? Because building a full 3 to 6 month emergency fund before investing means potentially waiting months or years before your money starts compounding. The starter emergency fund approach gives you a basic safety net immediately while still letting you start investing as quickly as possible. I would put this 1,000 euros in a high-yield savings account, a Tagesgeldkonto at ING, DKB, or Trade Republic's own savings feature. Safe, accessible, earning a little interest while it waits. Once the starter emergency fund is in place, I would split my monthly savings between two goals simultaneously, building the emergency fund toward the full 3 to 6 month target and starting to invest. Not one, then the other. Both at the same time. This keeps the momentum going and gets compound interest working as early as possible. With my foundation in place, I would open a Trade Republic account immediately. We've covered exactly how to do this in a previous video. It takes about 10 minutes, verification is fast, and you can start investing the same day. Then I would choose exactly one ETF. Not 2, not 5. 1. For me, that would be the iShares Core MSCI World UCITS ETF, ticker IWDA, accumulating version. Here's my reasoning. It tracks 1,500 companies across 23 developed countries. It has a TER of just 0.20%, extremely low. It has over 60 billion euros in assets, making it one of the most established ETFs in Europe. It automatically reinvests dividends, maximizing compound growth. And it's available on Trade Republic with zero commission on savings plans. Could I pick the Vanguard FTSE All World instead? Absolutely. It's equally excellent. Could I add an S&P 500 ETF alongside it? Sure, but starting from zero, I want simplicity. One ETF, one savings plan, no complexity, no decision fatigue, no second guessing. The biggest enemy of beginner investors isn't picking the wrong ETF. It's overthinking, overcomplicating, and ultimately doing nothing. One good ETF beats endless research into the perfect portfolio every single time. This is the most important step, and it's also the simplest. I would set up an automatic monthly savings plan on Trade Republic into my chosen ETF. Whatever amount I could genuinely afford without it feeling painful. Even if that's just 25 euros per month to start. I would set the execution date for the day after my salary arrives, so the money is invested before I have any chance to spend it on something else. And then I would forget about it. Seriously, I would not check my portfolio every day. I would not panic when the market drops. I would not get excited when it rises and invest more than planned. I would simply let the automatic system run month after month while I get on with my life. This is the hardest part for most people. Not the setup, not the research, but the psychological discipline of leaving it alone. Markets will drop. Your portfolio will go red. That is not a problem. That is the system working exactly as intended. Short-term volatility is the price you pay for long-term returns. Every dip is the market going on sale. Your savings plan automatically buys more shares at lower prices. Set it. Forget it. Let compound interest do the heavy lifting for decades. Starting with 25 or 50 euros per month is completely fine. The habit and the system matter far more than the starting amount. But I would make one commitment to myself. Every time my financial situation improves, I would increase my monthly contribution. Every pay rise, put at least half of the increase into the savings plan. Every bonus, invest a meaningful chunk. Every time I cut a subscription or reduce an expense, redirect that money to the ETF savings plan. This incremental approach to increasing contributions is one of the most powerful wealth-building habits that exists. You barely notice each individual increase, but over years, the monthly amount compounds alongside the investment returns into something genuinely life-changing. Starting from zero, with 25 euros per month, and gradually increasing to 200, then 300, then 500 euros per month over several years is a completely realistic path to building serious long-term wealth for almost anyone, regardless of their starting income. The key is starting now, not next month, not when things feel more certain. Today, because every month you delay is a month of compound interest you can never get back. So that's exactly what I would do, starting from zero today. Clear high-interest debt first. Build a starter emergency fund of 1,000 euros. Open Trade Republic and choose one broad global ETF. Set up an automatic monthly savings plan and leave it alone. Then increase contributions consistently over time as your income grows. 5 steps. No complexity, no shortcuts, just a proven system that works for anyone willing to start and stay consistent. Subscribe to SimpleWealth for simple investing content every single week. Drop your questions in the comments and we'll see you in the next one.